Welcome everybody to our pre-council meeting for March
Let's go with 15.
15th. Let's try the 15th.
Yesterday was Pi Day.
Okay. For March 15th, 2021, as always, in the back of the room, we have an Opens Meetings Act posted. And today we're going to have a nice discussion about our pension plans for the city of Lincoln.
Thank you very much. My name's Paul Lutomsky. I'm the pension officer. I'm here with the plan administrator, Doug McDaniel, and our actuarial consultants. I'm going to turn the presentation over very shortly to Pat Beckham and Brian, and they'll be going over the valuation results for August 31, 2020. Yep. Thank you.
Well, good afternoon.
Good afternoon.
It's a pleasure to be here. I'll be honest, I'm a little out of practice from giving in-person meetings, because this is about the second one I've done in a year. So hopefully that will go well. So you have the presentation. Brian, let's go to the first page. As Paul said, we're here to present the results of the August 31, 2020 Actuarial Valuation. So you got to roll your brain back about 6 months to that time frame. A lot of work goes into the valuation as far as gathering the membership data and the asset information and getting all that kind of put together, and then it takes some time for us to find the right time to talk to you guys. But just, I'm going to kind of start us off a little bit of a reminder of what this process is about, because you only hear from us once a year. And then Brian will go into the details, give you a little bit, put a little bit of meat on the bones, so to speak. And then we have a little bit of, risk analysis at the end that I'll come back in and weigh in on. So want to just remind you, this is the Lincoln Police and Fire pension plan is what's called a defined benefit plan. The amount of the benefit that a member will receive at retirement is what is defined by a formula that's based on years of service, a benefit multiplier, and final average salary. So it's a very long-term obligation. When we do the valuation, the stream of benefit payments that we're valuing can go out almost 100 years by the time you take into dependents receiving after the member dies. So we have a very long-term perspective, and sometimes that's easy for folks to forget that, like, our time horizon for funding this is very long, and it's an ongoing plan. So it's almost a perpetuity. It kind of goes on forever. The valuation, although it's an extremely long-term obligation, we want to keep an eye on it from year to year and how it's doing with the funding, right? The first thing we have to do is really quantify or put a price tag on the value of those future pension payments, which is complicated by the fact that we don't know when people will leave employment with the city. We don't know when they'll retire. We don't know when they'll die. We don't know what will happen to salaries between now and then. So we use actuarial assumptions. Every 4 years we do what's called an experience study. We look at all the actual experience on the demographic side. That helps us craft demographic assumptions. We get input from the investment advisor on the investment return assumption. And we use those assumptions to basically develop an array of future benefit payments for each member under each possible scenario where they may draw a benefit: disability, death, termination, retirement. And then we value those, and that gives us the liability. So that's the target. This is how much money we have to accumulate over time. Well, we've got to start on that because we've got assets in the trust fund. And the difference between those two is what has to be funded in the future. And that's what your funding policy helps say, is how much every year in the future will be paid to make up that difference between liabilities and assets. So that's really what the valuation is all about. We're monitoring that funding progress. We make a lot of assumptions in the valuation, and they hopefully are reasonable and close over the long term, but from year to year, there will be variations, particularly investment return. You all know that. We've experienced that extreme volatility from a year ago to now to where the market is now. So the valuation kind of captures everything that's happened since the last time we did it. And then it essentially recalibrates. It creates a new glide path to how we're going to get to 100% funding, that difference between liabilities and assets that I talked about earlier. And that's why we do it every year, so that we can make changes in the contribution as we go along, instead of waiting 5 years and coming back and then there's, a huge increase or a huge decrease. We do the valuation August 31, and then there's a kind of a 1-year lag as far as the fiscal year to which that amount applies. So the 8/31/20 valuation sets the contribution for September 1, 21 through 8/31/22. All right. So when we talk about the valuation this year, we had no change in plan provisions, actuarial methods, or actuarial assumptions with one exception. And the reason that's important is you'll see a lot of comparative information, the 19 valuation, the 2020 valuation, so it's important to know if there were changes that are significant there. When we did this in-depth experience study back in 2018, we recommended a decrease in the investment return assumption, a decrease in the expected return on the assets, again, over the long term. And we're at 7.5, and we recommended moving to 7.25, and to implement that and kind of create a smoother contribution pattern, we're doing that in 5 basis point increments. So in the 19 valuation, we moved down to 7.45. This valuation, we're at 7.4. Next year, we move to 7.35. So that change, that was a change in one of the key assumptions from 7.45 to 7.4. And when that happens, when the investment return assumption goes down, liabilities and costs go up. Okay, because the only 2 sources to pay benefits are investment income or contributions. So when we change that investment return assumption, we're saying we're going to earn less in the future. So we have to start putting more money in to offset what we're not going to make on the investment return side. Okay. You can see that increased the actuarial accrued liability by about $2 million, which is, I think it was about 0.6%. Yeah, we're at about $343 million. So it's only 5 basis points. It does have an impact. And then, again, contributions are going to go up because we're saying we're not going to earn as much in the future. Again, the schedule is to kind of drop that 5 basis points each year, but that does have to be approved by the city. So if something really extreme happened, that gives us I'm in there with you, a little bit of leeway there to deal with an extreme situation. And then there's always a difference between the actual experience versus what the assumptions would have anticipated, and that will impact the valuation. Brian will share with you. We quantify that as well to kind of help you understand why the numbers are moving. So just a very high overview. Brian's going to cover these numbers in a lot more detail, but kind of the key metrics that come out of the valuation. Again, this is back to August 31, 2020. The unfunded liability is up at $77 million. In the prior valuation, we were at 72.4. And remember, about $2 million of that increase is due to that assumption change. Okay, so that wasn't a surprise. Funded ratio, rounded anyway to a whole number, held steady, which is good news. And then when we look at the actuarial contribution rate, we're at 26.63% compared to 26.14% in the prior valuation. Again, we talked about the increase from the change in the assumption. I think that was 42 basis points if I remember right. Yep, 42 out of the 49, so that was the biggest piece. But you will notice that the employee contribution rate is actually a little higher this year. And again, Brian will go into that detail, but we have members contributing at different contribution rates. And that's why that's a sort of a blended rate. Eventually, over time, that's going to trend up to 8. So the difference between the total and what the employee pays is obviously the city's contribution. And as a percent of payroll, which is how we're developing these costs over time, we're at 19.13% this year compared to 18.76 last year. When we take that times expected payroll for fiscal year end '22, we're at 10.5 million in the 19 valuation, which is in the current fiscal year, we were at 9.7, so up about 800,000. And again, we have a lot more detail to share with you. We're going to try to keep moving through this. We could talk for hours, but we know nobody wants to listen to us for hours. So Brian, why don't you get us going?
Thanks, Pat. So as Pat mentioned, we'll go through a little bit of detail just on how these numbers get developed, because I feel like it's good to know what the final number is, what the contribution is for the city, but it's also helpful to kind of have the background on how we get to that point for everything. So the first slide, the total membership, these are the members in the system that are due or will be due a benefit in the future. So we have it broken down by the current and the prior year counts of members, and the two biggest groups are the members who are currently active, currently accruing a benefit, and so we had just over 600 members this year versus 590 last year, so almost about a 3% increase. And the next biggest group are the members that are currently in pay or currently receiving a benefit, and that's that bottom row, the retirees, disabled members, and beneficiaries, and that group was also up by about 2.5%. So overall, about 2.7% increase in the total population. And again, these are the members that, as Pat said, we're projecting out benefit payments into the future for all these members. So as the membership changes, the amount of those projections change as well, which changes our liabilities, and we'll get to there. So the membership drives the liability section, or the liabilities for the valuation. As Pat said, we're collecting money to put into a trust to pay for these benefits in the future, and we do so with a method called the actuarial value of assets. So the money in the trust is your market value. We do not directly use the market value when we're coming up with the contribution rates and the funded ratio. We use this actuarial value, which is essentially a smoothed value of assets. And the reason we do this is because the market value returns can be so volatile. So if you see in the graph on the middle of the page, the blue line are market value returns over the past 19 years. The red is the smoothed, or the actuarial value of returns during that same period. And you can see that the blue line is much more volatile than the red line. The actuarial value return will be sometimes above, sometimes below, which is what we would expect, but much more narrow as far as the volatility goes. And the reason we use this, the asset smoothing method is really because it creates more stability in the contribution rates. So instead of having a high rate one year and then it drops back down, this kind of just mitigates that change. So this is not uncommon. Most public systems do use a smoothing method, so this is nothing out of the ordinary.
Before you leave that slide, the other thing that to me is always interesting, and it looks this way for almost every client we work with, is how rare the actual return is close to the solid line, which is the assumed rate of return. They tend to be way higher or way lower, and that's the challenge with funding these plans, and that's why we use smoothing. But they're never close, so it seems.
So on slide 7, we look at what the assets did from the prior year to the current year, or from August 31, 19 to 20. So looking at the left column, the market value of assets, we started with $246 million in assets, and at the end of the year we had $267 million. About $12 million of that was from contributions between members and the city contributions. The city paid out $17.6 million in benefit payments to members that are currently receiving, and then we had about $500,000 in administrative expenses, and then $27 million of net investment income. So that's where we end up with the $267 on a market value basis, which translated to just over 11% return on the assets. Because we are smoothing these in, the right column, or that actuarial column of assets, has all the same contributions and benefit payments, but the net investment income is different as we are smoothing in those returns. So when we have a really good return, we're only recognizing a portion of it. If we have a poor return, we're only recognizing a portion of that as well, 20% each year. And so that helps mitigate those big swings. So the asset value that we're actually using for all of our numbers in the valuation is this $266.1 million, the actuarial value. The actual value return was 7.8% for the year, which is higher than what our assumed rate of return was. And so you'll see later that we actually have an actuarial gain, which helps reduce the unfunded liability, reduce the contribution rate, and we'll see. The last point on this one, the difference between the market value and the actuarial value is just over $1 million, but the market value is higher, which means we have deferred gains. So even if we earn our assumed rate of return next year, so that 7.4%, we hit it exactly on the dot, which we know we won't, as Pat said, but if we did, we'd still have an actuarial gain as we're smoothing in some of these built-up gains that we've had from the past. So on slide 8, we compare the two main pieces of the valuation. So the actuarial accrued liability, again, this taking all those members, projecting out their benefit payments, helps us get this liability as of today, and we compare the 2 years. So this is $343 million as of August 31, 2020. The next line down, the asset value, or the actuarial value of assets at 266. The difference between those two is our unfunded actuarial accrued liability of $77 million. You divide your assets by your liabilities, now that's how we get that 78% funded. So the funding ratio is really a lot of systems will use this like a key metric, but there are so many different pieces that go into it at your assumed rate of return. You can't just take what is our funded ratio versus another system's funded ratio and compare those two. It's really, there's a lot more detail that goes into them, but this is one of the kind of key metrics that a lot of systems look at, so that's 78%. So the next slide, we looked at what the unfunded actuarial accrued liability was. We said we moved from $72 million last year to $77 million as of August 31, 2020. How did we get there? What changes happened? And so on slide 9, this lists out all the different changes that affected that unfunded liability amount. And I won't go through all of them. Kind of the key ones are that third row down, the investment experience. So 800,000 or 0.8 million decrease in the unfunded. So again, we had a return on the actuarial value of assets that was above our expected return. And so when our assets do better, that lowers the liability or the unfunded liability that we have left to pay off. The next row down, the liability experience, that increased the unfunded by about 2.7 million. And the majority of this was due to salary increases that were higher than assumed. So we have an assumption what each member will make or will have salary increases each year. And that assumption, or there was more than the assumption for this past year. So that increased about 3 million. And then as Pat mentioned before, the assumption change going from 7.45% assumed rate of return down to that 7.4, and that was that 1.9 million increase in the unfunded liability. So that's where we get to the 77 million in unfunded for the current valuation. Slide 10 is just a graph of what the historical funded ratio has looked like over the past 20 years or so. For the first 8-9 years up until 2008, till we hit the Great Recession, the system was right around 95 to 100% funded. And then you see the decline for the next 8 years or so as the poor asset returns got smoothed in and drove that funded ratio down. In 14 and 15, we had assumption changes where our assumed rate of return was lowered. And so when we lower the assumed rate of return, that increases our liabilities, so that decreased the funded ratio even further. And then you see a little spike in 2016, which was the merger of the COLA pool fund into the general fund, which increased the liability or increased the funded ratio there. And then we've been kind of hanging around the 80% for the last 4 or 5 years, with each of the last couple years when we dropped from 82 to 77.7, and then this current year as well, small assumption changes that have come in. So again, you can look at the graph and say, oh, what happened here? But you really need some of the context behind it, like what's been going on as far as assumption changes and in the market. So it's just kind of a graphical explanation of the past 20 years. All right, so we're going to move to developing our actuarial contribution rate. And so the plan is funded from contributions from both members and the city. And there's really two main pieces to this contribution that get developed. So the first piece is the normal cost, and this is the ongoing cost of the system based on the current membership or the current active members in the system. And it depends what the assumptions in the benefit structure change that as well. So a more valuable benefit structure, it will have a higher normal cost or a higher ongoing cost because it's more expensive. So that's the first piece of the contribution rate. And the second piece is, if you remember that $77 million, that's our unfunded liability, we need to come up with a way to systematically pay off that liability or that unfunded liability. And so the way the city UAAL, or the Unfunded Liability Payment, works is we pay it off with a level percent of payroll. And so most people have a mortgage, and so you're going to, let's say you pay off your mortgage over 15 to 30 years. Most people will pay off a level dollar amount. So you're going to pay the same amount every single month, and that will take down the principal as well as cover the interest on that. This is a little bit different because we're paying off a debt, but it's on a level percent of payroll, meaning we expect payroll to increase by 2.75% each year, which means our expected payments or our payments on this debt will also increase 2.75% each year. So it's not just a level amount of dollars going in to pay this debt, is an ever increasing amount of dollars to go in. But that dollars that are increasing stay the same as a percent of payroll when you divide it by the payroll. So wanted to take a few seconds just because I feel like sometimes that gets lost when people are thinking about how to pay off this debt as a level percent of payroll. The other thing is we use what's called a layered amortization approach, and I'm going to flip to the next slide because I feel like it's easier to see this than to actually explain it. So on slide 12, we show how the UAAL payment is developed. And don't worry, I'm not going to go through all these numbers. Only Pat would enjoy that as an actuary.
And I might not.
But what this really shows is each line is a different layer or a different base, and is calculated as its own payment. So if you look at the very first one, the 2016 UAAL base, the original amount is $54 million, and this is by far the biggest piece of that unfunded liability that we have. So if you go a couple columns over to the outstanding balance, that $56 million is a big portion of our total $77 million of unfunded liability. And this will be paid over the next, there's 24 remaining payments. And these are close, so next year will be over 23 payments and then 22 as we go down until this is fully paid off. And then each row below that is a base that gets established when there's different experience. So like what we talked about before, we had higher salaries than expected. That will flow into one of these bases, or all the different liabilities that don't happen exactly as expected. If we have an assumption change, we also layer that as well. And this just really shows the transparency. So instead of having one number, a 77 million, and everything is jumbled into one, this shows some transparency or some more detail on how did we get to that 77 million. So again, I won't go through all that, but the bottom line is we have a payment of about $5.5 million for the unfunded payment. If we divide that by, I'm looking down at the very bottom, the projected payroll for fiscal year 2021, our payment on the unfunded liability is 10.77% of payroll. Okay. We mentioned earlier that members also contribute to this plan to help fund for it. There are a number of different plans with the police and the fire. So you'll see these all listed out here: old plan, plan A, B, and C for police, and then A and B for fire. The majority of members are currently in plan A. So we have, I believe, about 95% of current active members are in the plan A benefit structure. But we still do have some in the old ones. And so if you look across, like at the old plan, we have currently 2 active members in the old plan, and this is as of, again, remember our snapshot date, so they may or may not have retired since then. The effective, or the employee contribution rate for that group is 7.6%. But For the old plan and plans B and C, once you reach a certain amount of service, 21 or 26 years, you stop contributing. So for members in all the other plans besides Plan A, they are no longer contributing, whereas the Plan A members are still contributing 8% of their pay each payroll. So really the key number on this whole slide is in the bottom right corner, where it says the total effective employee contribution rate of 7.5%. So this is a blended number of some members contributing 8, other members contributing 0, blended on their payroll to get 7.5%. And the key point here is that this number will continue to increase until we have no old plan members, no B and C members, and then that contribution rate will be 8%. So continue to trend up towards 8%, which will bring more money in from the members to help the city pay for the future benefits.
Brian,
Yes.
because I'm listening to the plan A, B, C, it's probably counter to what people would expect in terms of naming the plans. But the newest plan is actually Plan A. And you made that clear, and the older ones are B and C, so you'd think it'd be the other way around, so I apologize for the city's naming confusion on that issue.
The actuaries didn't name them, just to be clear.
Good
But
point.
yeah, good clarification though. Okay, so on slide 14, to look at the total contribution rate, or the actual determined employer contribution, we have the current year and the prior year. So the valuation date, current year, the August 31, 2020, as Pat mentioned before, is for the contribution for the fiscal year beginning September 1, 2020. So again, what we came up with on this valuation has a 1-year lag for when that rate will come into effect, or that dollar amount of contribution will be due. So the total normal cost, again, the ongoing cost of the plan, the 15.86%. Members are helping pay for part of that, so we take 7.5% away from that 15.86. So the employer normal cost percentage is down to 8.36%. That's that first part of the contribution rate. That second part, paying off our unfunded liability, the UAAL contribution rate is at 10.77 that we had come up with before. Add those two together and we get the 19.13% of payroll. The projected covered payroll for the year is about $52 million. You take those two times each other, and then we add in expenses as well. So if you're back there doing the math, you're not going to get the exact amount. We also have expenses in there, but it comes out to $10.5 million as far as the actual employer contribution amount for the fiscal year beginning September 1, 2021. If you look at last year, that $9.7 million is what is the contribution amount for September 1, 2020 that we're through August 31, 2021. So the year that we're currently in. A look at the historical employer contributions are on the next slide, just to kind of see where we've been. The red line on here is the actuarial contribution amount for each of those years, each of these 17 years, and then the blue bars coming up are the actual contributions that were put in by the city. So you can see over the last 4 years we've been right on with where we with the actuarial amount, but they have increased over this time, and a lot of that was what we talked about before, like that funded ratio. As the funded ratio decreases, we need to put in more contributions, so it kind of follows that same pattern, just the opposite way, or inversed. The last 4 years we've been right around 8 to 8.5 million in employer contributions, but as we saw on that last page, the 9.7 million and then the 10.5 million to kind of keep pace, we're gonna see a little jump over the next couple years. And then probably one of the more important slides on here before I give it back to Pat is looking at the 5-year budget request estimate. So this is the contribution amount in these bar graphs that is the actuarial amount for the city that is estimated over the next 5 years. So you can see in the first bar the 10.5 million that we just saw on the prior pages, as well as the next 4 years going out. I'll note that these projections do have built into them our assumed step down in the actuarial, or the assumed rate of return. So we're at 7.4 now. Next year it assumes we'll be down to 7.35, and again that increases our liability. So all those changes in assumptions are built in, but you can see that we're stepping up. So 10.5 million. The following year is about 11 million that's expected, and then 11.5, and then that fourth year where we sit about 12. All of our assumption changes have been smoothed in, or has been recognized at that point. And then there's still a small increase because of the pay. Again, we assume that pay is increasing each year, and if we're paying off this as a level percent of payroll, that pay, or that rate does not change, but as payroll increases, our contributions still increase. So again, a little bit of projection in the future. Again, these are not what we believe they're going to be. We're not saying, yep, it's going to be 11 million this year. It's just, if all assumptions are met, this is what they would look like. Okay, and I'm going to let Pat talk about some of the risks of the plan and then kind of wrap us up.
Thanks, Brian. So the big caveat on slide 16 that Brian just went through with you, the big if is obviously if all assumptions are met. To be honest, the only thing we can tell you is that that won't happen every year for the next 5 years or the next 30 years. And so that's what kind of these last few slides are, just to help you kind of understand some of the funding dynamics. And we're just isolating investment return because that's tends to be the most volatile. You know, mortality, retirement, yeah, there's some variation, but it's not nearly what it is on the investment side. So slide 17 is an attempt to just model for you, because a picture's worth 1,000 words most generally, especially when they're my words. What impact does it have if the actual return for 1 year is different than what the assumption is? So right now, you know, our assumption is 7.4. The blue line on slide 17 is exactly the numbers that Brian just went through with you. So if all assumptions are met nice and pretty, including the step down, so a little bit lower return in those intervening years, that's what the number looks like, and we ended up right around 12.4 million for fiscal year end 26. But what if, instead of 7.4, we get a 14.8% return? Let's do the happy scenario first.
Yeah, I like
That's
that.
the green line, right? So again, if you earn more, that means you put less in contributions, because we're still sort of targeting to be fully funded at the same point in time. It's kind of like if you're driving from here to North Platte, and if you get to Grand Island and you're kind of ahead of schedule, you decide you could stop and get a burger and eat, and you're still going to get to North Platte, 4 hours later. So under the green line, which is the higher return, again, that's just for 1 year. The contributions fiscal year end 26 are, under 11 million. But then if we look at the red line, which is what happens if we have a 0% return, which isn't, that improbable when you're looking at the distribution of expected returns. Now, this doesn't have any bounce back or anything else happen. It's just one sensitivity analysis. Well, then by the time we get to 2026 and we smooth all this in, that's why we're looking ultimately further out, the contribution's closer to 14 million. So just that difference, of 7.4, and we call that an actuarial loss, because the actual return was not as high as what we are anticipating and sort of baking into our numbers. So to make up for that, it's a couple million higher, or if it flips and it's a good experience, it's a couple million lower. So that, you could look there and you've got, a range from 11 to 14 million, which is, I assume, not inconsequential to the city. But every single year we have this going on as far as what the actual return is. And over the long term, you've met your assumption. It's just the year-to-year variability makes it very difficult from a budgeting standpoint. But that assumption is key. So the next slide on 18, that model was modeling what actually happens on the market value of assets. We did not change our underlying assumption. Slide 18 is if we did change the underlying assumption. So let's say somehow we have a crystal ball and we know exactly what the investment return is going to be for the next 50 years, and it's going to be 6.9%. Well, we would change the assumption because we're not going to use an assumption that we don't think we can earn, okay? And if we did, we talked about this numerous times, if we lower the investment return assumption, we're saying we're not going to get as much revenue from investments. So that means we have to contribute more. So liabilities go up and costs go up. And you can see right now in this valuation, the numbers Brian shared with you were 19.13% of pay, which was about the 10.5 million. If we use an investment return assumption, if we dropped our assumption 50 basis points to 6.9%, the contribution rate would be 23.51%, so over a 4% difference. And the dollar amount of employer contribution instead of 10.5 million would be almost 12.8. So again, just trying to, our job as actuaries is to try to communicate the plan, not just where we're funded at now, but what if things happen different than what we're assuming, and what if it's dramatically different? What are the implications, just so you're aware of it. It isn't really anything you can necessarily do, but it's, knowledge is power. So to the extent that you recognize these factors, especially the actual return versus expected, you know what the trends are going to be, and hopefully there's less of a surprise when something happens. So again, we include some of this information in our report to try to make sure that all stakeholders understand the risk associated with funding the plan. And the risk is not just negative. I mean, you saw on the prior slide, if we earn 14.8, that's risk to actuaries is uncertainty, variability. And that's what we're trying to communicate here. So we will wrap up, let you get on with your day. Slide 19, really the major factor in this valuation was that reduction in the investment return assumption from 7.45 in the 2019 valuation to 7.4 in the 2020 valuation. We anticipate, absent something ugly happening, that we will be at 7.35 in the 2021 valuation. We're hoping to get down to 7.25. This trend is happening across the United States. These investment return assumptions are ratcheting down. Brian covered the plan experience, actual versus expected. We had a little bit of a gain on assets, which was nice. We had a loss on liabilities, and that kind of happens where they kind of offset a little bit. Overall, it did increase the unfunded liability and the contribution a little bit, but the big factor was the investment return assumption change. And the last bullet's really the key one, which is we just need to keep reinforcing to you as the employer that those future funding results, when we stand before you a year from now and share with you the 2021 valuation results, we know the investment return assumption will be lower, and we know the impact that'll have. What we don't know is what will the investment return be for fiscal year end 21. It looks pretty good right now, kind of like cash it in and hold on to it, but you can't do that. So if it's better than the 7.454, if it's better, that will tend to drop the contributions a little bit. But remember, we smooth it because we know the market gives and the market takes away. And basically, we're heavily dependent on that actual investment return. I would just kind of foreshadow or kind of share with the council, we only work with governmental plans, and so we sit in on meetings and listen to a lot of different investment advisors. And what we're hearing is because the bond returns are so low right now, interest rates are so low, that part of your portfolio is not providing, anybody's portfolio, is not providing much of a return in the short run. And so it's likely that the short-term returns will be lower than what our long-term assumption is. And so we should, sort of expect that if things kind of play out the way the investment folks think they will in the next 5 years, maybe 10 years. The valuation kind of corrects for all that, and it'll just raise the contribution a little bit for the next 20 years to pay for that difference. Okay.
Thank you. Do we have any questions? Yes, Councilperson Christensen.
I have one for staff. Can we get this presentation in electronic format?
Already, yeah.
Yep, it'll be posted on our website. We'll be happy to send it to you as well.
Okay.
Okay. Sounds good.
All right, well, thank you.
That was a great explanation, thank you.
Yay.
You guys, do we have any other questions for staff?
Thank you, Paul.
Okay. Seeing none, we will stand adjourned until 2 o'clock. Thank you.